all the top pickers will realize, oh gosh, I messed up again. But silver during that 4-month period, what's it done? It's gone up nicely while gold's gone sideways. So the spread is shifting, favoring silver, meaning gold's gone sideways, silver's gone effectively vertical. So it's no surprise that silver went from 34, 35, 7, 8, 9, almost 40. And I think it's just begun. In fact, I think
Hi, everyone, and welcome to Alternative Edge Report. I am your host, Olivia Voz. And if you are new to alternatives, well, the show has just started. So we welcome you to the show, and we welcome our special guest, Michael Oliver, today, the founder of Momentum Structural Analysis, to weigh in on all of this action. Michael, welcome.
It's good to be here.
It's great to have you on. And I have to start off with silver because it's been steadily higher since last year, but it feels like it's really picked up momentum recently. It's testing right around $40. What is the backstory here?
I won't give you the story. In other words, a fundamental story. We look at the technicals. I mean, I know what the fundamental story is. It's the ongoing degradation in the money units, fiat currencies. Doesn't matter which one. They're backed by nothing. And ultimately, over time, gold and silver hold their value for an investor. In recent years, silver's lagged gold a bit. In other words, they both made major lows in 2015 and have advanced significantly since then in an arm wrestling manner. In other words, it's been, if you're too focused on what this month or next month's going to do, you're panicked out of the market, every other month. And there's many technicians out there who encourage you to exit the market because it's a top or it's going to correct big, et cetera. But actually, it's been now 10 years and gold has gone from 1,050 to 3,500. So ongoing with it had a 20% correction in the middle of that. But silver has lagged, especially since 2020. Silver reached up just below 30 and then pulled back from 2020 to 2023, while gold really went sideways, and therefore silver underperformed gold. That's changing, and I think it could change dramatically. And if you go back and look, for example, 50 years ago, and look at every year and figure out what is the price of silver in relation to gold, divide 1 ounce into 1 ounce, and what is that percent? And you'll find that 21 of those 50 years, silver was at least 2% of the price of gold. Well, right now, silver is 1.16% of the price of gold. It's coming up from a low that was below 1%. So silver recently has been very, very low. So you ask about silver, I think its prime dynamic right now is it's going to catch up to the mama metal, and it's going to outpace it. It's going to be the better place to be, especially, I think, between now and the end of this year.
So, Michael, you are looking at silver as catching up to gold. That's why we've seen this. But you find it's going to surpass gold. Why is that?
Yeah. Well, again, if you go back 50 years and you find what was 21 of the 50 years, not even bull market years necessarily, silver reached 2%. Well, if silver right now were 2% of the price of gold, it'd be $60, $70. Okay, divide, 2% of what the gold is. Gold's not stopping here. It's paused for 4 months. This boring sideways action. And it's going to re-engage as well. I think very soon you're going to blow out the recent highs and all the top pickers will realize, oh gosh, I messed up again. But silver during that 4-month period, what's it done? It's gone up nicely while gold's gone sideways. So the spread is shifting, favoring silver, meaning gold's gone sideways, silver's gone effectively vertical for the last since the April low. April low is 27.50, and we're now 39.50. Okay, so quite a move. It's going to continue, and if silver merely returned to the 2% level, I mean that would be right now standing still, it means it's going to almost double from where it is now relative to gold. So it's double better than gold right now. If silver merely returns to its more or less normal relationship to gold. But in bull trends in silver and gold, like in 79, 80, or 2010, 2011, in those latter years of the bull trends, silver went ape on the upside. It went up to 3.5, even one time up to 6% plus the price of gold. So, and I say this is also going to be true with the gold and silver miners. They're going to outpace gold because they've underpaced gold for the last, well, since mid 2020. But I think it's indicative of the initial wave of doubt that there is in the U.S. stock market. No, it got up, made a new high recently. We're extremely negative on the U.S. stock market. I think it's topping. I think it's been topping since late 24, early 25. We're marginally above those highs, but I still think it's topping. But that money goes somewhere. And historically, if you go back and look at major bear markets in the stock market, you'll see gold did quite well. In fact, it was one of the few places to be during those bad periods. And to some extent, that's not just because money's moving out of the stock market and seeking a new home. It's also because central banks, whenever the stock market starts to implode, they will naturally start to cut rates and do anything they can to liquefy the system, to protect those assets that they deem worthy of protection. They don't care about commodities. Heck with commodities. Corn farmers can go broke. We don't care if price goes up there. But we got to keep the prices of stocks up. Okay. Also, when the stock market turns down, that's when the data points, things like unemployment or economic indicators indicating the weakening in the economy, that's when the data points go south. So the stuff that Powell's talking about that he needs to see before he can cut, bet on that happening after the stock market starts down again. And that's when they'll start to do what they always do. And if you go back and look at 2007 top, 2000 top, the dot-com, before the market really started to implode, the Fed started cutting rates. They'd been on pause for a year or two, and then they suddenly put pedal to the floor. Let's print the money. Let's do QEs, whatever. It did not help the stock market. That money flow went into monetary metals. And it's not that gold had to wait for that event because it's been rising for 10 years. Again, it's an issue that over decades and decades, gold holds its value to the degrading money unit. And all you got to do is look at an M2 chart. Federal Reserve,
Yes.
St. Louis, they publish. Okay. It's just like an upward
Go back
ballistic
to economics,
missile.
macro 101.
Yeah, in other words, they're destroying the money unit. It's backed by nothing but hopes and wishes and lies. And gold holds its value. And young kids today haven't learned that, but their granddads knew it. And so the granddads no doubt told them, you should buy gold. Well, now maybe the kids are starting to realize maybe I should have. I think we're at that point. But I think it's going to be different. We can get into that later if you want.
Well, Michael, that's why we have a lot of viewers and maybe some kids out there too that are getting wisdom from their grandparents. They're here to look at the alternatives because the market is feeling a little toppy. So I know you carry the one and you can understand how silver will be mooning, but what is your expected target this year? And are you expecting any major pullbacks to that target?
No, I think silver had its cleansing pullback in April. Now, that's when it tried to, or some investors assumed that if the stock market goes down, silver must go down too. So they dumped on silver. And if they did, they got their neck ripped off because within days it shot from 27.50 up to 30, 31, 32, 33, way off that low. And then finally emerged through the old dual highs at 35 that we had October last year and March of this year. And now we're living up close to 40. I don't have an ultimate target for the bull market. I do have a pretty solid assumption, philosophically based on my libertarian views and what I've learned in time about gold. This time, gold and silver are going up, but they're likely not to come back down. In other words, you're not going to get a bull market peak and a major bear market that follows. This time, I think the global outcome, the U.S. outcome in particular, economically speaking, monetarily, will be totally upsetting to assumptions, to institutions, and to a lot of investors who don't realize what's going on. This is not a normal boom-bust cycle. This bust will not be normal in the stock market. It is based on a 15-year bull market, one of the oldest in U.S., in fact, the oldest bull market in U.S. history, printed in place by M2 growth and Fed funds rate taken to zero for 10 or 15 years. And even after they upticked it, a year or so ago, it was at levels that are in the lower quadrant of the past 75 years of rates. So we've had effectively free money for 15 years. Well, that's like getting drugs in your arm. You get hallucinated, you make decisions based on that, you hire employees, you build new factories, you make all kinds of positive assumptions based on the underlying value of the money in it, which is, it's rapidly decaying, but the nominal value seems good. And the money, the cost of money, a factor in any business decision, heck, it's free, or next to free. So errors are made, personal, corporate, government, et cetera, and compounded and compounded. Not only is the age of the bull trend like triple any prior bull market, its increase in price, the multiple gain is far more than the 23 to 29 bull, or the 1994 to 2000 dot-com bull, or the 2002 to 2007 peak that preceded the mortgage crisis. There's no comparison. So we have the biggest bubble, especially in U.S. market now. I'm not talking about a lot of other markets that don't have bubbles. But when it's in our lap, and that's the biggest lap to be in, because when we expunge the errors that occurred in that period of time, the damage will be global. And gold knows what central banks are going to do. That's what they do. They print, they save their governments, they try to save their government debt markets. They take any steps they have to that continues to distort the underlying real value of the money in your wallet. Gold is the only alternative, and silver. And therefore, this time around, I think what's going to, at the end of this, I think it's going to be institutionalized. I think we're going to end up with gold-backed currencies and silver-backed potentially around the world, here, there, and pretty soon everywhere. Once this crisis hits full-blown, then people will say, this hasn't been working. Let's go back to gold. So instead of a bear market next time, you'll have gold as institutionalized.
So instead of the greenback, we'll be looking at the silverback. And like you said, Michael, the only free cheese is in a mousetrap. I've always heard that expression as well. And that is the fundamental backdrop. But let's focus on the technical backdrop. You said you use technical analysis a lot in your studies. What is your favorite indicator that you like to use when you're tracking something like silver or gold?
Well, what we measure is the momentum of the market, and we don't use that noodle indicators that when you go to your computer screen, a quote screen, you'll see things like RSI or MACD, which everybody has for free on their screen. And they move like wet noodles, so to speak. They get up to a certain level and they drop to a certain level, and like a little snake. And a lot of people misinterpret let's say RSI is overbought. Well, that's next to meaningless, because it's measuring a certain distance back in terms of what's normal for overbought or what's normal for oversold. And when you get into dynamic bull trends, you can go back and research this yourself, punch up a monthly or a weekly RSI of gold and silver. But during the massive surges, like 79 to 80 or 2010, 11, those readings got rammed to the roof. And they were overbought for maybe 5-6 months straight in a row. And that's the time you made the most money, is when they were, quote, overbought. What we look at is structure of momentum. And by that, I mean, when we plot momentum, what we do is we take the price action, like a bar chart of price, daily, weekly, monthly, whatever. Usually we're focused more on long term. And we plot it in relationship to certain long-term moving averages. we don't overlay the average on price chart. That's next to meaningless, whether you get above it or below. When you oscillate it, you get either above the average or you're below it, and therefore you're either on the plus side of an oscillator or the lower side. And it builds a chart, just like a price chart, except it looks different. And quite often it'll smack you in the face with its clarity of structure, meaning, for example, right now we look at the stock market, and you see this upward curve week by week. It's not explosive, it's just arm wrestling, but it still goes up every week. But when you look at a momentum chart, you've got repeated lows at a 3/4 average at a zero line on an oscillator, such that you can tell if you ever break that floor, you're going to puke. You look at the price chart, you don't see it. On silver, for example, we had a structure that, last May of last year, silver reached 32.70. It was a surge high. It then leveled off and oscillated fairly violently for a year till May, June of this year. You could draw a line from that 32.70 and it got above it and got below it in violent swings, but really it was lateral. So when you look at price, it looked like a mishmash. But we plotted a momentum chart of that. We had a perfect parallel downtrend channel that anybody didn't even have to be a technician. You could see this beautiful multi-wave corrective phase that silver was going through on momentum. Well, prior to coming up and blowing out those two price highs at 35, October last year and March of this year, we came up through there in June, late June. In very early June, we get up above 34 again. You weren't at the old highs. And that structure on that momentum chart was blowing out, saying, I'm out of here. Okay. So it's no surprise that silver went from 34, 35, 38, 9, almost 40. And I think it's just begun. In fact, I think you asked a while ago about, what did the technical show for soon, let's say. Between now and year end, it is our assumption and my personal investment assumption, and I do show my positions, they're not the size, but what markets I'm in our reports at the tail end, I show what I own. And I'm heavily emphasized in silver, double silver ETFs, and silver miners. To a much lesser extent, gold and gold-related miners. I think silver could easily take out the old phantom highs at $50 of 1980 and 2011, which are, like ages ago. They're almost meaningless. Why? Because the real value of the currency unit over those decades to the present has decayed so much, you'd probably have to be $200 silver just to match the real value of silver in 1980 at 50, okay? But I think we're going to surge to 60 to 70 between now and the end of the year, which is, say, a handful of months. Well, and I think gold will go up during that time, but nothing like what silver is going to do. Now, is that the end of it? No, that's not the end of it. That's just an acceleration phase out of this underpriced metal.
That oscillator indicator that you're talking about, or the way that you track it, reminds me in Twister when they throw the balls in the twister and it reads everything, and finally you're able to see the future in those patterns. Real quick before I let you go, Michael, you did mention that a lot of the miners have been lagging and their time to shine will be coming up. Any miners that our alternative investors should be keeping an eye on?
Well, we have all asset category subscription, which we cover all four major asset categories. And that's very important today because gold is not on its own. I mean, you've got to watch the government bond market, the stock market, as I said, as it starts down, that money goes somewhere and it always goes into gold. So that'll help accelerate the monetary metals. But in case of the silver miners and gold miners, we do put out a monthly report to our subscribers, in which what we do is we go through like GDX or SIL, the ETFs of the silver and gold miners, and look for outperformers. And by that, I mean, we don't look at the price chart. We look at a spread chart versus, let's say, Pan American Silver versus the GDX or Coeur mining, the silver miners I'm talking about here, versus GDX. Are they trending stronger than GDX? And we plot the spread, and the spread chart is the relationship between those two. And we select maybe a dozen, 15 each month that look to us like the better places to be within the broad basket. You can always just buy the basket and you'll do fine, GDX, SIL. But my emphasis right now is actually the silver miners, just like silver has been underperforming gold since mid 2020 and now is starting to turn. If you look at silver miners compared to the gold miners, they also underperformed the gold miners. But that spread is now turning up, favoring them. So my personal emphasis is in the silver miners. So I've picked up 3 or 4 that I think are better. They're the bigger silver miners. I'm not going to specify what they are because it could change over time. But I'm emphasizing ownership more of silver miners than gold miners. Because like silver, I think it's going to beat gold. I think they'll beat the gold miners. But the miners in general look like a far better place to be than gold. In fact, if I were to give you a number right now that might occur over the next, I won't say by the end of this year, but over the next year or two, it would be easy to see the miners triple in relative value to gold from where they are right now. Meaning, as gold goes up, they go up 3 times as much. And this is a technical assessment. It's not a gut feeling. So I think that is the better place to be, and silver is the better place to be than gold, although gold is the mama. You need to watch her. But right now, anybody who's concerned about a downturn in gold, forget about it. Even the price chart action since April is not ever the way gold tops out. When gold makes a peak, it makes a peak and it drops hard. And then you may try to get back up to the peak, but you never do. 2011 is a perfect example. Same is true with the low in 2015. Once you made that low, you didn't come back to it. Well, look at the last 4 months in gold. It's a sleep sideways. That is not a topping action. That is a launch pad for the next up leg in gold. And silver's already not waiting for it, as we've talked about. So anyway, that's my personal emphasis, is the silver side of the equation. And I think it's going to demonstrate itself in a dramatic way between now and the end of the year.
Silver, it is cool to the touch, but hot to trade. Michael Oliver, thank you so much for joining us today and giving us some insight on gold consolidating, ready to break out, silver taking over the show. And my viewers, make sure to watch those silver miners. They are going to catch up as well. Thank you for watching the Alternative Edge Report. Again, I am your host, Olivia Voz. Make sure to like and subscribe.